Hello everyone, this is Yash Nama. Thank you for joining me in this video. Today we will revisit target costing and relevant costing by going through some practice questions on these topics. So let's get started.
So Henry is the managing partner of a business that has just finished building a 60-room motel. Henry anticipates that he will rent these rooms for 15,000 room nights next year. So what does this mean? 15,000 room nights, and how many rooms does he have in his motel? 60. 50,000 upon 60 tells us that he expects that each of the 60 rooms will be occupied for about 250 nights a year. This is what we mean by 15,000 room nights, because there are 60 rooms in the motel, right? 60 rooms in the motel, and Henry anticipates that he will rent these rooms for 15,000 room nights. 15,000 room nights upon 60 rooms available suggests 250 nights is the number of nights each room will be rented out, okay? Occupied. All rooms are similar and will rent for the same price. Henry estimates the following operating costs for the next year. Variable costs are $5 per room night. So variable costs could be things like soap, shampoo, all the basic amenities, supplies which are given in a hotel room. And then we have fixed costs. So variable costs is very minimal, $5 per room night. Fixed costs, salaries and wages, $173,000. Maintenance of building and pool, $52,000. Other operating and admin costs, $150,000. Total being $375,000 of fixed costs. The capital invested is $900,000. The partnership's target return on investment is 25%. Okay, so if 900,000 is the investment and target return is 25%, what is the return they are expecting? 225,000. Now Henry expects demand for rooms to be uniform throughout the year. He plans to price the rooms at full cost plus markup on full cost to earn the target return on investment. Okay, so what price should Henry charge for room night? What is the markup as a percentage of the full cost of a room night? So let us work out some numbers. Now, if we are talking about 25% return on 900,000, that's 225,000, and that should be our operating profit, right? So if we are basing our costs on full cost plus a markup, we need to earn revenue of 15,000 room nights times a selling price, which we do not know at the moment, right? Which should cover all our variable and fixed costs. We said investment was 900,000 times 25% return on investment gives us $225,000 operating profit. Fixed costs are given to us $375,000. If our operating profit is $225,000 and fixed costs are $375,000, how much is our contribution? And variable costs are pretty straightforward. 15,000 room nights times $5 variable cost, right? This suggests in order to earn a profit of $225,000, they need to have a sales of $675,000, and if this is for 15,000 room nights, per room night it will be $675 upon 15,000, which will be $45 per room night. This is what they need in order to get a profit of $225,000. What is the full cost per room night? Total cost is equal to fixed plus variable. In this case, total cost is equal to 375 plus 75, 450,000. 450,000 upon 15,000 room nights, $30 per room night. Total cost. Selling price 45, 30 total cost. What's the markup? 50%. So this is fairly straightforward. Henry's market research indicates that if the price of a room night determined in requirement A is reduced by 10%, the expected number of room nights Henry could rent would increase by 10%. So if they decrease the selling price by 10%, the number of room nights will increase by 10%. So 15,000 will become 16,500. So should Henry reduce prices by 10%? Show your calculations. Sales will be earlier selling price 45 times 0.9 because there's a 10% reduction in selling price times earlier room nights 15,000 times 1.1 because there's an increase in the number of room nights. This will be our revenue. How did I get this? 45, which is the selling price per night, times 0.9 because there's a 10% reduction in the selling price, times 15,000, which was the earlier number of room nights, times 1.1, which is 10% increase in the number of room nights. So this gives us a sales of 668,250. Less variable costs. Variable costs, 15,000 room nights, earlier room nights times 1.1 because there's a 10% increase in the number of room nights times $5. 82,500. Contribution, 585,750 less fixed costs. Will the fixed costs increase if the number of room nights increase? No, so it will still be 375. Operating profit, contribution minus fixed cost, 210,750. So would you like to decrease the selling price? No, because this will lead to a decrease in the operating profit. So what I've done here is selling price is equal to 45 times 0.9 and room nights is equal to 15,000 times 1.1. Price is reduced by 10%, so 45 times 0.9, and this will lead to an increase in the number of room nights, expected number of room nights, 15,000 times 1.1, 16,500. Yeah. So if we multiply these two numbers, we will have 668,250. So let's move on to the next question then. This is on target rate of return on investment, and this also uses some ABC type concepts. So Top Sports distributes video games to retail stores and video game venues. It has a simple business model. Order the video games, catalog the games on the company's website, deliver and provide on-site support, and bill and collect from the customers. The company reported the following costs in April 2018. You have different activities. So this is pretty similar to your activity-based costing analysis. You have 1, 2, 3, 4 different activities. Ordering, what is the cost driver? Number of game vendors. Quantity of cost driver 30. Cost per unit of cost driver 250 per vendor. Cataloging, cost driver is the number of new titles. Quantity 15. 100 per title is the cost driver rate. Delivery and support, cost driver is number of deliveries. 450 deliveries, 15 per delivery. Billing and collection, number of customers, cost driver, 300 customers, and 50 per customer is the cost per unit of the cost driver. In April 18, the company purchased 12,000 video game discs at an average cost of 15 per disc. And it sold them at an average price of 22 per disc. the catalog on the website and customer interactions that occur during the delivery are the company's main marketing inputs. The company incurs no other costs. Calculate the operating profit for 2018, April. If the monthly investment is $300,000, what rate of return on investment does the business earn? So first we will identify what is the profit, and then divide the profit number upon the investment number, 300,000, and that will give us the rate of return. So fairly simple. So we have just one variable cost and 4 overheads. Revenue, 12,000 discs times 22 per disc. Variable cost, 12,000 discs times 15. Contribution, revenue minus variable cost. Overheads, ordering costs, 30 vendors times 250 per vendor. Cataloging costs, 15 titles times 100 per title. Delivery and support, 450 deliveries times 15 per delivery. Billing and collection, 300 customers times $50 per customer. Total overheads is equal to sum of these numbers. And operating profit is equal to contribution minus overheads, 53,250. And what is the rate of return on investment? 300,000 is the investment. Rate of return, return on investment, ROI, is equal to profit upon investment times 100, 18%. 17.75 to be precise. Let's move on to the next bit. The current crop of game systems is maturing and prices for games are beginning to decline. The company anticipates that from May onwards, it will be able to sell 12,000 discs each month at an average of 18 per disc. So earlier selling price was 22 per disc. Now it will sell for 18 per disc. And it will have to pay the vendors an average of 12 per disc. Earlier it was paying 15 per disc. Now it's paying 12 per disc. Right? Assuming that other costs are the same as in April, will the company be able to earn its 15% target return on investment? So very similar exercise. Our fixed operating costs are not changing. Our overheads are not changing. This bit remains the same because there is no information on the overheads. The only difference is contribution. So if we were to work out this, 12,000 discs at 18 per disc, variable costs, 12,000 discs times 12 per disc. Contribution, selling price, sales minus variable cost, 72,000 is the contribution. Overheads, operating profit is equal to contribution minus overheads, 41,250. Now this is the profit. Now investment is still the same. ROI, return on investment, is equal to profit number upon investment number times 100. Profit number upon investment number times 100. 13.75% is the return on investment. And the question says, assuming that other costs are the same as in April, will the company be able to earn its 15% target return on investment? And the answer is no. Right, so what did we do here? We changed the revenue, we changed the variable cost, we calculated the contribution, we took the same overheads. Because the assumption is all other costs are the same as in April. So we took the same overhead number, calculated the profit based on new contribution, 41,250 new profit upon investment 300,000 times 100 will give us a return on investment of 13.75%. The company's small workforce gathers as a team and considers process improvements. They recommend firing the marginal vendors, those who need a lot of hand-holding, but whose titles are not very popular. They agree that they should shift some of their resources from vendor relationships and cataloging to delivery and customer relationships. In May 2018, the company reports the following support costs. So there are changes in the overheads. At a selling price of 18 and a cost of 12 per discs, how many game discs must the company sell in May 18 to earn its target return of investment of 15%? So here, you know what is the profit, you know what are the overheads. Because you know what is the profit, because you know what is the overheads, you can add them up to get to a contribution number. Once you have the contribution number, you know what is the variable cost anyways, and you also know what is the selling price per disc anyways. So you know selling price minus variable cost, contribution per unit. You know what is the contribution per unit, and you also know what is the total contribution. Total contribution upon contribution per unit will give you number of units to be sold. Okay, so this is for part C. Do we know what's the profit? $300,000 is the investment. How much is the return on investment, target return on investment? 15%. 15%. 300,000 times 15%. 45,000 is our target profit. We are working backwards. Now, do we know the overheads? Yes, we have them here. Ordering costs, 30 vendors times 200 per vendor. Cataloging, 15 titles times 100 per title. Delivery and support, 450 deliveries times 20 per delivery. And billing and collection, 300 customers times 50. Total 31,500. We know what is the profit, we know what are the overheads. Can we calculate contribution? Contribution is equal to profit plus overheads. So 31,500 is the sum of these, right? So contribution is equal to operating profit plus overheads, total contribution. Per unit, what is this revenue? Revenue is 18 per unit, variable cost is 12 per unit, contribution is 6 per unit. Total contribution 76,500, contribution per unit 6. Total contribution upon contribution per unit will give us number of units to be sold. Award plus manufactures medals for winners of athletic events and other contests. Its manufacturing plant has the capacity to produce 10,000 medals each month. Current production and sales are 7,500 medals per month. The company normally charges $150 per medal. Cost information for the current activity level is as follows. Variable costs that vary with the number of units produced. We have direct materials, 262,500, direct labor, 300,000. Variable costs for setups, materials handling, quality control, and so on that vary with the number of batches. 150 batches times 500 per batch, $75,000. So unit level activities, and these are batch level activities here. Fixed manufacturing cost 275, fixed marketing cost 175, total cost 1.8087 million, 1,087,500. Award Plus has just received a one-time only order for 2,500 medals at $100 per medal. Accepting the special order would not affect the company's regular business. Award Plus makes medals for its existing customers in batch sizes of 50 medals. 150 batches times 50 medals per batch gives us 7,500 medals. The special order requires the company to make the medals in 25 batches of 100. Okay? This means there will be a change in the batch level costs for the special order, not for the regular order. Should the company accept the order, special order, show your calculations. Okay, so all I've done is we'll have on the one hand normal business and we will have special order side by side, and then we can take a look. So, revenue. The company normally charges 150 per medal and it's currently producing 7,500 medals per month. So, 7,500 times 150, right? Special order, how many units? One time only special order for 2,500 medals at 100 per medal. 2,500 times 100. Now, variable costs. Direct materials 262,500. Labor 300,000. And we have variable costs which vary on the number of batches here, okay? So essentially it is setup, material handling, quality control costs. So this is 150 batches times 500 per batch. Contribution for normal business is sales minus sum of all variable costs. Fixed costs. Manufacturing and marketing. Fixed manufacturing costs 275. Fixed marketing cost 175. Operating profit, contribution minus the sum of fixed costs 37,500. For the special order, do we know batch level costs? Do we know the number of batches? Number of batches are 25. And what is the cost per batch? 500. So we can calculate the batch level costs. How are we going to calculate the material and labor costs? 25 batches of 100 each, whereas the normal batches are 150 batches of 50 medals per batch. So normally they manufacture 50 medals per batch, now they're manufacturing 100 medals per batch. So if anything, they are saving on the batch level costs. So, batch level cost, 25 batches times 500 per batch. 12,500. Now, do we know the material and labor costs? Normal business is for 7,500 units, medals. So, per unit material cost. Per unit material cost will be 262,500 upon 7,500, 35. Per unit labor cost will be 300,000 upon 7,500, 40. This is our per unit material and labor cost. Special order is for how many units? Special order is for 2,500 units. So what am I going to do now? 2,500 units times 35 will give us the labor material cost. 2,500 units times 40 will give us the material cost. We have batch level variable cost 12,500. Contribution will be revenue minus sum of all variable costs, 50,000. Will we have any additional fixed costs? Fixed costs are the same, irrespective of the level of output, so we will not have any additional fixed costs. Operating profit will be contribution minus fixed cost, which is 0. In this case, additional fixed cost, profit will be 50,000. Will you accept the order? It will give you more profit than selling 7,500 medals. So, it's not a peer-to-peer comparison because we are not taking into account any fixed costs for the special order because fixed costs do not change. So anyways, this will cover you have additional 50,000 contribution to cover your fixed costs, so you will be accepting the special order. Suppose that plant capacity were only 9,000 medals instead of 10,000 medals each month. The special order must either be taken in full or be rejected completely. Okay? Should the company accept the special order, show your calculations. Earlier the capacity was 10,000, but now the capacity is 9,000. Your regular business is 7,500 medals. Special order is 2,500 medals. So if you accept the special order, you will have to forego 1,000 units of your regular order. So your revenue from the regular order will go down. Okay? So can we take a look at the numbers for this situation? So we have normal business and special order next to each other. If we accept the special order, what will be the revenue? Revenue will be what we calculated earlier. Right? If we accept the special order, material cost will be 87,500. If we accept the special order, labor cost will be 100,000 for the special order. If we accept the special order, labor cost will be 100,000. Contribution, batch level cost will be 12,500. Contribution will be this. So there is no difference in this bit if we accept the special order. So essentially all these numbers will still be the same. But there will be a difference to your normal business. Why? Because your total capacity is not 10,000, your total capacity is 9,000. If you produce 2,500 units for special order, how many units can you produce here? 6,500 units. So what will be your revenue? Revenue for normal business. 6,500 medals times 150. Material cost. It will be 6,500 times 35 per unit. Labor cost 6,500 times 40 per unit. Batch level costs. If we are producing 6,500 units, how many batches do we need? Normally, the company produces 50 medals per batch. Right? If it is 50 medals per batch, 6,500 upon 50. This is the number of batches, 130 batches times, what is the batch level cost? 500 per batch. We reduce the number of batches based on normal business. Normally, the company produces 150 batches times 50 medals per batch, 7,500. But we have to let go 1,000 medals of this business, right? So this is why it will be 65,000 batch level costs here. 6,500 medals upon 50 medals per batch will give us the number of batches times 500 is our batch level variable cost. Now contribution is sales minus sum of variable cost 422,500. Will there be a difference? Will there be any changes to fixed cost? Contribution minus the sum of two fixed costs will give us a profit. In this case, it's a loss of 27,500. Because our fixed costs are not going to change irrespective of the level of output, right? So in this case, if we accept the special order, our normal business will go down because the capacity is not 10,000 but 9,000. Now, Would you accept it? We are not comparing answers from option B to question from A. We are not doing that because now the capacity is not 10,000, now the capacity is 9,000. Right? If the capacity is 9,000, if you accept the special order, this is what will happen. But what if you do not accept the special order? If you do not accept the special order, your profit will be this. Because you're doing the normal business of 7,500. So, if you do not accept the special order, your profit number will be this. And if you accept the special order, your profit will be 22,500, which is the sum of, which is 50,000 minus 27,500 loss from your regular business. So it will be sum of these two numbers, 22,500. If you accept the special order, 22,500. If you do not accept the special order, 37,500. What will you do? Keep the normal business and turn down the special order. Next, item 3. As in requirement 1, assume that the monthly capacity is 10,000 medals. The company is concerned that if it accepts the special order, its existing customers will immediately demand a price discount of $10 in the month in which the special order is being filled. They would agree that the company's capacity costs, they would argue that the company's capacity costs are now spread over more units and that existing customers should get the benefit of these lower costs. Should the company accept the special order under these conditions? Okay, so this is a slightly different situation. So we are back to 10,000 capacity per month. We are not at 9,000, we are back to 10,000 capacity per month. Because it says, item 3 says, assume that the monthly capacity is 10,000. So we are back to square one on capacity. Now, if we accept the special order, the numbers for the special order will not change. Numbers for special orders will still remain this. So special order is easy. Normal business now will be back to 7,500 units. Right? Normal business will be back to 7,500 units. Your cost will still be the same as your original costs. Your cost numbers will still be the same. Fixed costs will also remain the same as your original calculation. Now, what did they say? The existing customers will immediately demand a price discount of $10. So earlier they were selling 7,500 medals at $150 per medal. Now they'll have to sell 7,500 medals at $140 per medal with a $10 discount. So 7,500 times 140. This is our revenue for the normal business. Contribution will be revenue minus the sum of variable costs. Fixed cost is this, and profit will be contribution minus sum of fixed costs. Loss of 37,500. Loss of 37,500 from normal business if we accept the special order. Because if we accept the special order, your regular customers are going to demand a discount, which is what led to a loss here, because your revenue reduced of $10 per unit. So earlier it was 150, now it is 140. So total profit here is 12,500. 50,000 minus 37,500, 12,500. So would you accept the special order? No, because it will give you a total profit of 12,500. Whereas if you did not accept the special order, you would be sitting with a profit of 37,500.
I hope this video was useful to you. Please feel free to email me if you have any questions. Take care and goodbye.